Hello everyone, welcome back. In today's video, we are going to discuss student loans. Whether you're buying a house or refinancing, if you have student loans, it could affect your ability to qualify. Now, over the last couple of videos that I've done where I've talked about FHA loans or VA loans or even conventional loans, I often have people reaching out asking about student loans and qualifying. So I wanted to take the time today to discuss this because this is a very tricky topic and it differs depending on who your lender is and how your student loans are structured to be repaid. So I want to start by telling you that, if you're looking to refinance, if you're looking to purchase, make sure you're working with a professional. Make sure you're working with someone that knows how to do this, because this is one of those topics. If people don't truly understand how to calculate it, they could tell you that you are qualified when you're not, and they could tell you that you're not qualified in some cases when you could actually qualify. So, as many of you guys know, I'm a real estate broker. I'm not a loan officer, not a mortgage broker these days. That was my life quite some time ago. But, I put out these videos to help you understand these topics, to make sense of them, and help guide you through the process. So do me a favor, if you like videos like this, hit that subscribe button. So now, a moment ago, I mentioned it's a tricky subject. Why is it a tricky subject? Because the way that student loans report on your credit report could make the difference in how people calculate your income. So as many of you know, if you've been watching my videos, lenders qualify you based on your debt to income ratio. That's how much monthly debt you have versus the income that you bring in. And student loans are one of those payments that are factored into your debt to income ratio. And depending on how it's reported, when someone qualifies you, they use that amount. In some cases, they don't use that amount. They may use a different amount to qualify you because there's not an amount reported. So your credit report may report that you don't have a payment at all. It may report that you have a zero monthly payment. In some cases, there may be a payment there, but it's not a fully amortized payment. And in some cases, you're on some sort of income-based repayment plan with your student loan company, and that payment might be reporting. So, that's why it's helpful and almost necessary to make sure that you're working with a professional in these cases so that they can ask the right questions, get the proper documentation from you in order to make sure that they're reporting the most accurate information when looking at your debt to income ratio to tell you whether or not you are qualified. Let's start today's video by talking about FHA loans. Now, FHA has made it pretty clear on how they deal with student loans when it comes to qualifying for a mortgage. The underwriter must use all your student loans in your debt to income ratio, regardless of the payment type or the payment status. Regardless of the payment status, the underwriter is going to use the greater of 1% of the outstanding loan balance, which is usually the most common one, the actual documented payment amount, or if the actual documented payment amount is less than 1%, and you can provide proof that it's fully amortized, then they'll use that payment. So what does that mean? That means that they don't allow income-based repayments. So if you're on an IBR, FHA loans will not allow you to use that payment towards your student loans. How they typically calculate it is they take 1% of the loan amount. So if you have $100,000 in student loan debt, they're going to factor $1,000 per month in your debt to income ratio. So $1,000 per month added to your debt to income ratio. And this is probably the biggest problem when using FHA loans to qualify and having student loan debt, because typically anybody using FHA generally has a lower down payment amount, and factoring in $1,000 toward their debt to income ratio is usually the nail in the coffin and hurts most people's ability to qualify for a loan. Now let's take a minute and talk about Fannie Mae loans. Now, Fannie Mae loans are typically associated with those putting a little bit more money down, let's say 5% or more. The way they calculate student loans here is going to be probably the most forgiving for anyone qualifying for a loan. So you can be on an income-based payment plan or an income-driven repayment plan. One of the repayment plans, you can use it in order to qualify. And depending on how it reports on your credit report will determine how Fannie Mae uses it. So if if it reports as a 0 monthly payment on your credit report and you can provide proof from the income-based repayment plan that your payment is actually 0, then they will use that 0 amount in order to help you qualify. But if you're not on a repayment plan, which I suggest that you should be, if you're not, they will use 1% of the loan balance. So kind of like FHA, but the thing with FHA is they don't allow the IBRs, which typically allow for a lower monthly payment on the student loans, where Fannie Mae does allow the IBR and will use whatever payment shows up on the repayment plan. Now, Freddie Mac is a lot like Fannie Mae in that they'll use what's reported on your credit report if the balance is greater than 0. So if you have an amount showing up on your credit report, a monthly amount that's greater than 0, they will use that amount in order to qualify you for your loan. But if the amount on the credit report is 0, they use a 0.5% of the outstanding loan balance. So similar to FHA, but in this case, instead of it being 1%, it's 0.5%. So on a $100,000 outstanding loan balance with student loans, that would be a $500 a month monthly payment that they would add to your debt to income ratio. Lastly, let's talk about VA. These are loans for veterans. VA calculates things a little bit differently. In fact, if you can provide proof that your student loans are not to start for at least 12 months from the time that you close your loan, you have written documentation of that, they won't factor that student loan payment into your monthly DTI. But if your student loan is in repayment or scheduled to begin within the next 12 months, they use a formula to calculate your monthly payment. Basically what they do is they take your loan balance, multiply it by 5%, and divide it by 12. In the case that you have $25,000 in student loan debt, they multiply that by 5%, which is $1,250, divide that by 12, and that gives you a payment of $104.17 per month. So that is the amount that they would use towards your debt to income ratio. So I know all of that is very, very complicated depending on what type of loan you're getting. And that's why it's super, super important that you're dealing with a professional, someone that understands, the loan business, someone that's been doing it for a long time, someone that can walk you through and guide you through that process. Because as you can see from what I just discussed, it's tricky. It's complicated for someone like me that even understands the business, because each one of these different types of loans calculates a little bit differently. And for most of you out there who have student loans, you're on some sort of income-based repayment because it's the most effective way to repay student loans, because it's based off your income and the size of your household. So that way the number is reasonable versus getting some crazy number per month in student loan debt. So I hope that is helpful in explaining that. If you do have additional questions, you want to be connected with someone who can help guide you through that process and answer those questions for you, do me a favor, reach out to me directly. I'm happy to make that introduction. I appreciate you taking the time to watch this. If you've made it this far and you haven't done so already, do me a favor, hit that like button. But I appreciate you, again, taking the time. I appreciate your support and hope to see you again soon. Have a great day. Bye-bye.